analyzing the rupee now under the scanner with an economist, Sajjid Chinoy of JPMorgan, and Anant Narayan of Standard Chartered, who will be joining us in a second. Sajjid, how do you interpret the Reserve Bank's action or inaction, if you please? Would you say that to argue in the bank's favor, the Reserve Bank allowed the currency to adjust to certain macroeconomic changes that have happened? The Indian inflation seen compared to the dollar-denominated inflation, which is really next to nothing, as well the worsening of the trade deficit, which means you just have to allow your exporters a better chance and punish imports in some fashion.
I completely agree. I think targeting an exchange rate in this environment where global risk aversion is so high and regional sentiment is so low is both impractical and undesirable. I think when you run a large current account deficit, the way you respond to a large global shock like we have seen over the last 6 months is through a floating exchange rate. That becomes your shock absorber. That becomes your equilibrating mechanism for exactly the reasons you pointed out. Exports boost, imports become more expensive, your trade deficit compresses. I think more generally they didn't have any option. Given the size of India's foreign exchange market, it's impractical for the central bank to come in and defend a particular level. So I think it's more desirable and I think it's practical for the RBI to sit by the sidelines, try and smooth volatility to some extent, but I think it's just not possible in this day and age to defend a certain level.
And yet there has been a hue and cry, Sajjid, and one argument goading and requiring the Reserve Bank to come in is that there was an element of panic, and perhaps after a point the field was left open to speculators, to probably hedge funds, where the lack of intervention from a central bank only made matters easier for them. So would you say that maybe part of the depreciation was justified, but at some point the Reserve Bank has to come? So it's intervention, but discretionary intervention.
Well, I would say clearly where the rupee is today is not justified by the fundamentals. This is clearly overshooting driven by panic. And the panic is a lot of homegrown. What you're seeing right now is a self-fulfilling weak equilibrium. Exporters are just not selling their dollar receipts in the hope and the belief that the rupee is going to get weaker. When exporters don't enter the market and it's an illiquid market and you have to import crude oil, for example, the rupee does get weaker and exporters are proved right ex post facto. So they wait out even longer, and that's what we've seen. If enough people in India believe the rupee is going to get weaker, it will, unfortunately. So we've got into this self-fulfilling equilibrium, and I don't think the current value is justified either by the balance of payments fundamentals or even by any measure of the real effective exchange rate, because the RBI depreciation over the last 4 months is about 15 or 16%, far offsetting the appreciation over the last 18 months because of the inflation differential.
Now I was wanting to come to that issue, so before I allow Reema to ask her question, Sajjid, the real, even as of October end, was 8% overvalued, or rather the rupee was overvalued at 108.70.75 even as of end October, after the depreciation from August to October, accounting for another 4 or maybe 4.5% in November itself, or even 5%. In real effective exchange terms, compared to the 6 currencies that we trade with, we are still overvalued by about 3% or 3.5%. So would that justify that the Reserve Bank's action was correct until now? Would that be your stance?
Well, I would say that when you talk about overvaluation or undervaluation, typically you're assuming some equilibrium level. Now that equilibrium level is not a static thing. In a country that's got a significant growth differential like India has with its trading partners, and one would argue that over the last few years productivity has been higher than some of its trading partners, especially developed markets, the real effective exchange rate is a moving target. So the equilibrium value for today is certainly higher than it was for 2 or 3 years ago. Viewed from that perspective, I'm less sure that we're still in such an appreciated state. I think there's been some overshooting for sure, and I think that the Reserve Bank's inability to come into the market, I think, stems from the fact that given what's happening globally, you do require some depreciation for the current account and the trade fundamentals to self-correct, and also from the fact that if the RBI were to intervene in a significant manner and it doesn't have much efficacy, then they are in a much weaker state going forward. The last thing you want to do, if it's a regional move like this, is that waste $20-30 billion of reserves and not be able to sustain a level. Then you're in a much weaker position going forward. So I actually believe that their policy has been appropriate. We are in a self-fulfilling weak equilibrium. These things, like in the past, can unwind very quickly. If you go back to December 2008, every rupee plunge since then, and I'm not saying this is like every rupee plunge, but every rupee plunge has had a very quick mean reversion in the next 3 or 4 months, because when exporters believe that they've missed the peak, then they sell in the flood, and that facilitates the mean reversion.
Anant Narayan of Standard Chartered Bank also joins in this discussion. Anant, afternoon, and thanks for joining us. Sajjid here is of the opinion that RBI intervention, while it is desirable, it is not practical. A, do you concur with that opinion? And B, if the RBI continues with its no intervention policy, where do you expect the rupee to gravitate to?
Sure. I would break this up into 2 parts, Reema. One is what the RBI needs to do in the short term, and what it needs to do in the medium and long term. If you look at the last few days, this particular year we've seen the rupee depreciate by 18%. It's difficult to imagine this, but just about 2 weeks back, dollar rupee was below 50, it was 49.5 or something. So you've seen about 8% since then. We've clearly underperformed all of our regional peers. There are not many currencies in the world that have seen an 18% depreciation this year. Now, we are, like Sajjid mentions, into a cycle which is vicious, and where panic is sort of feeding into panic. Now, this is a moment in the short run where the RBI probably needs to intervene. Now, I completely agree that RBI's medium term, if they were to continue this on a medium term or a long term, it's probably not sustainable, because the underlying issues are bigger. The current account deficit is for real. We need this capital inflow to make good that current account, and one would even question whether having a large current account deficit is necessarily the right model for us to sort of have. But those are larger issues to look at the medium term. The first thing is to bring some semblance of sanity into the market in the short run, which the RBI is well equipped to do. It has the reserves. There are taps that it can open with the other authorities, including the Ministry of Finance, which can bring in funds, and it can, like Sajjid mentioned, give the comfort to exporters that levels have been seen where they can come in and start doing some meaningful hedges. All of that can bring some sanity in the short run, and subsequently you could take the steps needed to bring the medium-term current account and the overall balance of payments into some kind of equilibrium. So to answer your question, I think in the short run, given the level of panic, we've seen 80 paisa move yesterday, we've seen a 50 paisa move today. This is simply not meaningful. It has disastrous effects for the economy as a whole. We can't let this panic take hold of the economy as a whole. It can start to change the fundamentals if it continues. So there is a necessity to sort of put a ceiling on that for the short term, and then of course buy the time to sort of address the medium term issues.